Hello, everyone. My name is Marlon Caballero. I'm part of the Young American Business Trust team in Washington, D.C. On behalf of the entire team, I welcome you to this bootcamp session called Financial Plan. Today, we have the pleasure to have participants from the Talent and Innovation Competition of the Americas, TIC Americas 2019, as well as other members of the entrepreneurship community in the region. The agenda for this session is: first, I will read the biography of our speaker. Next, Ms. Ferreira will give her presentation. After that, a question and answer session will take place. And finally, we will have a conclusion and a few announcements. Now, I would like to introduce today's speaker, Ms. Romina Ferreira Peña, to whom we give her the most cordial welcome. Ms. Romina Ferreira is the Strategic Planning and Development Consultant in Inter-American Development Bank. She obtained a master's degree in finance from the Johns Hopkins University. She worked at HSBC and BBVA in Argentina and Asia countries. Ms. Ferreira, your microphone is open, so you can now start your presentation.
Hi everyone. So I'm gonna do a financial planning presentation. I'm trying to. I think you need to make me the presenting in the conversation or something. I can't share my screen. Okay, cool. Thank you.
You're welcome.
Okay, perfect. So I'm gonna do introduction to financial planning presentation. There's going to be a lot of information for one, and I'm assuming that um, everyone here don't have a background in finance or background in econ or accounting. So if you do have a background in finance, econ, or accounting, this might seem a little bit basic, but you can. We're gonna do some questions at the end, so you can wait until that to do like more advanced questions. Okay. So the presentation outline: what is an income statement and the break-even point? What is a balance sheet? What is a cash flow? I'm gonna show an example, and then we're gonna go for questions. So to begin with, what is a balance sheet? The balance sheet is an accounting statement, and it shows the situation of a business at a specific point in time. So we're gonna see what is the situation of one of that specific business at one day. It's like we take a picture of the situation of the business that day. For example, a lot of people, different companies do the close of business at the end of the year, or they do it at the end of September, and that's the picture that they take for reporting, right? And then what components does a balance sheet have? And then we have the assets, which are the goods and rights of the company. It has the liabilities, which are the debts and other obligations of the company. And then it has the equity. So it has the owner's capital investment and also the return earnings from previous years. So if you're a startup just beginning this year, you won't have the return earnings part, but you're gonna have hopefully some money from investors or like even from like yourself. So that's gonna be in the equity part. Okay, and now what is an income statement? It shows it's another accounting statement, right? And it shows the performance of the business on a period of time. Okay, so we were saying that the balance sheet is a picture of the situation on one day, And here what we're doing is a statement on how was the performance of the business over a period of time. So in the past year, in the past 6 months, whatever, but we're going to see different, like what happened in between a period of time. Okay. And the main components we're going to see in the income statement is the revenues. So that's the income generated by the business core operation. So all the products that were sold times the price. Then the cost of goods sold is the cost of the raw materials. There actually human resources, sometimes it is part of cost of goods sold, but most of the time it's taken into account in the fixed cost or other costs. So that's the next part, which is the other costs like administrative, sales, and financial costs. And those in general, you can also divide them by variable cost, which is the cost of goods sold, and then fixed cost, which is that like SG&A, that sales, administrative, and general costs or expenditures. Okay, what is a cash flow statement? A cash flow is the analysis of whether operations generate enough cash to sustain the business, and it's made, or its components are three different parts. It's the operating cash flow, which is the cash generated by the business core operations. So what I was saying before is all the flows of money that come to the business, and that we also and they're also like live the business, let's say, by the normal operation. So, for example, the income, all the revenues of selling our products, and also money that leaves the business is all our cost of goods. Then we have financial cash flow. So financing cash flow are the flows generated by the financing activity. So this could be either you have a debt, or you have investors, right? So all the money, all the inflows are going to be the debt, the capital that you get from the debt, and also the invested money, which is the equity. And then you're going to have outflows that are going to be the repaid of the debt principal, the interest, and also actually the interest are not in the financing cash flow, but they are the repaid of the principal is, and also the dividends that you're going to pay to the investors. And then the investing cash flow is generated by investment activities, and this is in the case that, for example, this is hard for a startup, but in the future, if you're making a lot of money and then the money is just sitting in there, you can put it in a bank account, and then they're gonna give you an interest for having that money there, and that the interest, like that income from that interest, it's gonna be on your investing activity. So why is this important? Okay, this is important for I divided in three reasons. One is for you're gonna be seeking investors, right? So those investors are gonna do a valuation of your project according to the present value of the future estimated flows. And then if they don't do it by that, which is called the DCF method, they're gonna do a valuation using multiples. So using the knowledge that they have on other different companies on the same industry. They're similar to your company, and then they're gonna say, okay, if these companies in the past gave us this much of a profit based on this investment, then given the financial planning of this new company, we can compare, for example, their revenues, and then we will know how much money we're gonna get, how much is the profit that we're expecting. And then also there are ratios to analyze trends in profitability, in efficiency, and that's for them to realize whether the company is expected to do well or not. Then the creditors, they do liquidity analysis and they do solvency analysis. So liquidity analysis is they're based on your financial planning. They're gonna be analyzing whether the company is able to meet their obligations. So to pay them basically. And also whether in the long term and in a very bad situation that the creditors don't want to get there, and neither do the owners of the company, but in a very bad situation that the company goes bankrupt, then they can also analyze how much are the assets and whether they could get their money back by selling their assets or whatever. And then the last is the managers. So you as a manager, you want to know how your company is doing in operations, right? Like you want to know whether you're becoming more efficient or less efficient. And there are different ratios that we're gonna see later in the example. Like for example, how many days it takes you to obtain if you're giving, like for example, if you're giving credits to your buyers, to your customers, like how much it's taking you to recover that credit, or if your suppliers are giving you credit, if you want to see if you're getting more financing from that part. For example, if your suppliers are giving you a longer time period for repay or not. And then you also want to know like the financial planning, what are your expectations for the next 5 years, 10 years, if you want to, I don't know, increase your plant or buy new equipment, things like that. You need to have a plan, right? Like you need to know when you have to meet your obligations first and things like that. And yeah, then efficiency analysis, as I was saying, there are different ratios to analyze whether you are being efficient or not. What is your margin, your profit margin over your revenues, and for example, if your profit margin is diminishing over time, then that is a red flag, right? Like what is happening there? Why is your profit margin? Where are you getting less profit for each unit of revenue? Okay. And now we're gonna go to the example. Find nothing here. Okay. So first of all, here we have this is how to calculate the break-even point. First of all, you're gonna put in a very basic Excel sheet what are your fixed costs or your wages, for example, wages, PP&E means plant and equipment, then marketing services, for example, if you're paying accounting or legal services and other costs. These are all examples. It's not necessarily that you're gonna have those costs. And then you're gonna put your variable costs and how much units you're expecting to produce in the first year. So you're gonna put input number 1, input number 2. Those are the cost of the materials, right? And then it's a simple division here. It's what is your cost of like your variable cost, right? Like what is the cost of the materials dividing the amount of inputs you're producing, and then that gives you the variable cost per unit. And then to calculate the break even, what you're gonna do is to divide. You're gonna add your fixed cost, your variable cost, and you're gonna divide that by the price, right? So this is a very useful tool because it shows you how many units you need to sell to cover all your costs given different prices. So these are very what this is saying is that if I sell my product at $5 or 5 pesos or whatever your currency is, I will need to sell 760 units in a year to cover all my costs. Whether if I sell it at 20, I would have to sell 190 units to cover all my costs. Okay, now we're going to the financial statement. So we need to make some assumptions, and this can be information that you have from your first and second year of operations, like from your beginning operations, or it could be just assumptions that you're making for the first year. So the first concept that we have here is the depreciation. So for the depreciation, that's an accounting concept that is trying to account for the cost of of using your fixed assets, right? Your equipment. So if I have, for example, a car which I use for my business, every year that car loses value, right? Because I'm using it, and then the depreciation is trying to account for that, mainly for tax purposes, right? And then PP&E, that's plant and equipment. So it's property, plant and equipment. So this is your fixed assets if you have any. Then tax, this is gonna depend on which country you are. This is the like income tax for your companies or any taxes that you need to pay based on your revenue. Then interest rate, this is the interest rate at which we are going to discount all our operations. So what is this interest rate? Is what is the the profit rate that an investor could get by investing in something else in that country, right? And then for the first year, oh, sorry, that was Spanish. For the first year, we're gonna have the revenues. So this is calling the other tab. So it's for what I just showed you, the 200,000 units I was planning on. No, it was 20. Well, the 20,000 units I was planning on producing and selling by the price of 15 pesos or dollars. And then we have variable costs also coming from the other tab, other costs or fixed costs coming from the other tab. And then these are calculations on profit margin. This is it's not calling anything on this tab, it's just a calculation of what profit margin you would get. Then you have interest expenditure, and this is the interest at which you get your debt, right? Like the interest you have to pay for getting debt. And then we have debt repayment. So I'm estimating here that I'm gonna repay all the debt I got in 3 years. Then I have inventory turnover days. These are all these operating ratios that I was talking about. This is how much it takes me to sell new inventory. Days receivable outstanding. This is how much it takes me to recover whatever credit I gave to my customer. And then days payable outstanding is how much time it takes me to repay my suppliers. But if you're selling or buying cash, you don't need to. I mean, this is gonna be zero, right? Then following years. This is a very important part of financial planning. Financial planning is that you're going to estimate your revenue growth here for 30%, which is that is going to be the inflation in the country times a percentage that you think you're going to grow for the next year. Then this is going to be the growth of your cost. So here I put inflation, but it depends if you think in the future based on what you've seen, if your costs are going to increase or not. And then dividends is the percentage of dividends that you're going to give after you pay everything, you have your net profit, and you're going to give that in percentage of the dividends to an investor, or it could be that you don't give them anything. It depends on what is your agreement, right? Okay, so first one, income statement. Here we're gonna have the revenues. So revenues again, it's price times the amount of units I'm selling, and then this is gonna grow by the revenue growth that I put as an assumption. Then the cost of goods sold, also coming from the other tab, other costs coming from the other tab, and these are growing by the assumption that I made of cost growth. Then depreciation, this is what I was talking about, this accounting concept of what is the cost of using my fixed assets, right? My PPE, my plant and equipment. So here I put that I had PPE for 5,000 and the depreciation is 5 years. So I'm gonna, each year that I'm using my fixed asset, my equipment, so for example, my car, I'm gonna be getting 1,000 as a cost, right? And then I get the EBIT. Then I have to also take into account the interest I'm paying. This is the amount of the debt times the interest rate, and I get the EBT. Then I get taxes, so it's EBT times the taxes is EBT times 30%, because that's what I said that my taxes were going to be, and then I get my net profit. And then after I get my net profit, I do net profit times my dividends to get how much is my how much is the dividends that I want to pay. And after all of that, I get the return earnings, right? Okay. So then I have the balance sheet. Okay. The balance sheet, first of all, I'm gonna look into my assets. So I have cash. Then I have accounts receivable. This is everything that I gave to my customers and they need to pay me. Inventories, all the goods that I haven't sold yet. And then I have short-term assets, right? Then long-term assets are my PPE, right? My plant and equipment. And then this is the sum of just the long-term assets and the short-term assets. Then I have the debt and equity part. So first part, the part of debt is accounts payable, all the money that I owe my suppliers. Then I have short-term debt. So this is the part of the debt that I have that is due this year. And then I have long-term debt. This is the part of all the debt that I have that is due in the next period, not this year. This is total debt. And then I have shareholders' equity. This is whatever my investors or myself put into the company. And then I have return earnings. This is from the earnings from previous years that I decided to invest. Okay, so this is shareholder equity, and then this is a check that we need to do. It's like all our assets are financed by either our liabilities or the equity of our investors, right? So if we do assets minus liabilities and equity, we would have 0. Okay. Okay, and now we're gonna have the cash flow part. So we're gonna divide cash flow from operations and cash flows from financing. I assume that we didn't have any investing in this situation. And again, we're gonna put the revenue that we got from the beginning. This is the revenue, actually it's not the revenue, but it's the net profit, as you see in there. And then we're gonna add back the depreciation, because as I said, depreciation is an accounting concept, right? But it's not that we are actually expending every year $1,000. So there is no money going out of the company for that part. And then, so we're adding it back because there is no money leaving the company because of that. And then we have change in accounts receivable. So for example, last year I had accounts receivable for 2,500 and now I have 25,000. What that means is that I'm giving credits to my customers much more than I did last year. So that's stopping me from getting that money in cash, right? So that's why we put it as an exit, even though there was no actual like money cash exit. We're putting it as an exit because it's yeah, that's stopping me from having actually that cash. And then we have accounts payable, which is the opposite. We had accounts payable for 2,000 and now we have for 45,000. And now what that's saying is that we are getting credit from our suppliers, and that is allowing us to consume without cash outflows, right? So we're putting it there in the cash flow. We're putting it positive because here we want to know how much cash we have at the end. Okay, so change in inventories is the same. In the past, you had inventories for 2,000. Now we have for 5,000, 7,500. Sorry, and that means that we are not selling those goods, and that those goods could have been also cash, so they're not cash. We also need to fix for that. And this is our cash flow from normal operations. Now we have the cash flow from financing. We have the debt repayment. We said that we were going to repay our debt in 3 years. So that's the amount of debt that the amount of cash that is going to go outside the company to repay debt. Then we have dividends, and that's all for financing, right? That we have the dividend part, and we have the debt part, sorry, and the equity part. Okay, so here we have our final cash flows. And the cash flows are very important for these two units that are very important for investors and for creditors. There are the IRR, the internal rate of return, and the NPV, the net present value. So the IRR is saying how much is your return based on your initial investment. And this is a very easy Excel formula for those that don't have a background in accounting and finance. And then your NPV is your net present value. And what this means is, okay, we have the flows for the next years, but we don't have this is the flows for the next years, but also the investors, like by investing in our company, they're missing from other investing opportunities, right? So they need to account for that opportunity cost of not having invested in something else, and that's why we are gonna do the future cash flows. We're gonna bring it back today to by doing this. What the NPV formula does is doing each cash flow over 1 plus the interest rate times to the power of the years that you are at. But that's a very very technical definition. But what I'm trying to show you here is that future cash flows are brought back to year zero by the NPV, by the net present value, by this 10% interest rate here. And that's what the investors could have gotten every year if they wouldn't have invested in our company. But in this case, it's a very profitable company, a very, very profitable company. In general, its IRRs are, for example, I don't know, I've seen from 10% to 30%, 50%, not more than that. 50% is already kind of a lot. You can see a 50% in a country that has a lot of inflation, for example. But yeah, that's pretty much everything I have planned for 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 my part. And now I'm gonna allow for questions.
Ms. Romina Ferreira, thank you for your such valuable information and for your excellent presentation in finance. Now we will start the question and answer session. If you would like to ask a question, you will have to click on the yellow hand icon that you will see to the right of the panel so that we can activate your microphone. Also, you can write down your questions, comments, and contribution in the chat room. My person will read them to be answered by Ms. Ferreira. Let's begin. Now I will proceed to read the questions in the chat room. The first question is from Ruby Martinez. What's the acceptable period of time before having profit in my startup?
Okay. Can you hear me? Yeah. Okay. Perfect.
Yeah.
I It really depends on. There is no golden rule for this. It really depends on which industry you are at. Um, for example, as an investor of a private equity fund or something like that, in general, they expect to exit the company, so to like invest and then to sell the company in a period of 5-7 years. So, and in general, they also invest after 1 or 2 years. It's more like venture capital, right? 1 or 2 years that the company has been in place, right? So I would say that, yeah. So I would say that those first 2 years, it's fine if there is no profits, but then for the next like 7 years, they need to make a big um make a big profit for the investors, right? Because they're looking for the company to value and then to sell it to someone else. But as I always say, also it really depends on the industry, because if you're, I don't know, if you're in the energy industry, if you're building a power plant or renewables or something like that, those are things that take a lot of time. So in general, their financial planning goes for 20 years, and it's fine if expected, if they don't make money during the construction period, that can take like 2 years, 5 years, and then they start making money until, for 20 years. So it really depends on which industry you are at.
Now I'll read the other questions from Jessica Alonso. How can I obtain the cost of capital rate?
Okay. Jessica, that's a very good question. It's a very technical one too. So there is a formula called weighted average cost of capital, and that formula. Let me check if I have it in here. Maybe I can just show it to you. Okay.
Jessica
Okay.
Alonso
Yeah.
also wrote another question.
Yeah.
It says, what item or equipment can be considered for depreciation?
Sorry. What can be considered for depreciation?
What item or equipment can be
Uh,
considered for depreciation?
yeah. Okay. That's also a good question. Okay, I'm gonna go for the cost of capital one. Maybe you can see my screen now, and that That's a very general formula to calculate your cost of capital. So here what we have is you're going to put the share of debt that you have in your financing. So for example, if 50% of your debt of your whatever your resources are debt, then you're going to put that D over D plus E is debt over debt plus equity. So that's going to be 50%. And then you have the RD is the interest rate of your debt, right? So if you're getting debt at that 12%, that's going to be 12%. And then that's going to be the 1 minus T is it's a tax rate, because everything you get, the good thing about debt is that interest payments or like are tax deductible. They're considered a cost for the company, so that's helping you to pay less taxes, right? So yeah, that's the debt part, and then you're gonna add the equity part, and this is a very hard part to find what is your return on equity, right? So here you're gonna put, for example, we said that we were 50% debt, 50% equity, and then you're gonna put the return on equity part. There is this is much more sophisticated in finance. There is formula called CAPM, but I think that's not very applicable to what we are doing right now, because that's mostly for companies that are traded on the markets and stuff. So for the return on equity, what I would do is to put a percentage of profit that other similar companies are obtaining, right? And that's how you can obtain your cost of capital. So it would be the rate of the debt, right? Your interest rate, when you have to adjust it for your tax, because you're not going to pay tax and that for that interest rate, and that the 50% or whatever percent your financing is overall, and then you're going to add a percentage of profit that other companies, that the investors can be getting at other companies, times the percentage of that. And for the other question, that was the what items can be considered for depreciation. That is going to depend on the rules of your country. So I'm pretty sure that no matter which country you are at, that must be accessible internet, but it depends. Not only depends what items you can consider, but also how many years you can depreciate. You can put as depreciation, because sometimes you can play with that too. Because if you put all depreciation in 1 year, for example, a car, you're going to have a very high cost on the first year, and then you're going to get a big tax credit for that, right? So in general, countries have some guides on how you can treat different assets for depreciation. For example, minimum of a car has to be like 5 years, something like that. So yeah, it's a very valid question, but it depends on which country you're at.
Thank you. Now I'll read a question from Agarda Ventur. What is cheaper, debt or equity?
What is cheaper? Okay. It depends on. That's a very good question, and it also depends on many things. It depends on which country you're at. It depends on which stage your company is. Because that always has the advantage that that you can get there is tax deductible, right? That what I was just saying is that you're getting all these interest payments are tax deductible. So in that sense, it's good to have debt because you're going to pay less taxes. But on the other hand, if you leverage too much, the cost of your debt, it's gonna be higher, right? Like they're not gonna give a startup the same rate that they're gonna give a company that has been there for 100 years and that has very little debt because they know you so that it really varies on what kind of company you have. It's the same, for example, for a company that has a lot of assets. Um, they probably are going to give them they're going to give a lower rate than another company that has the same the forecasted cash flows, but that has no asset whatsoever. For example, and I don't know, a software company, because if the case of a bankruptcy happens, then the bank is not going to have assets at all to get, um, as a payment for their debt. So it's a very good question, and I think you should be able to analyze at which stage you are in your business and what are your what is your position for getting debt. For example, if you're seeing that you're getting very high, very expensive debt, then probably equity is the best solution because it has no cost, right? If you don't want to give them dividends, you can reinvest everything, and they're gonna profit the day that they sell.
Thank you, Ms. Romina. Now the last question is from Ruby Martinez. What would you recommend if I need to finance my project since I'm starting from zero? Should I ask for a bank loan or should I seek for an investor?
Hi, Ruby. Um, it Well, again, it really depends. If you can get an investor, that would be a good idea. The problem is that many times you cannot. Many times their investors are not there, and you still need to finance yourself. So you can get a loan, or the opposite. Maybe you want to get a loan because you want to have tax um this like you want to have tax benefits, but no one is going to give you a loan if you're just starting and you don't have anything to back up that loan, right? So it's not a it depends on one at what situation you're at, right? Um, Also, yeah, they're probably they're not going to give you a loan if you don't have the expected cash flows, or you don't have you don't have an asset to back up that loan. But also, you don't want to get into that position that you're forced. You need to repay the loan. Maybe with an investor you can negotiate more, but yeah, it depends on what situation you're at.
Ms. Romina, wouldn't Gordy wants to ask a question, so we'll open her microphone.
Hello, everyone.
Hello.
Yeah, yeah, hi. I would like to thank Ramina for his great presentation. And as you said, I'm Mujini. I'm one of the winners for the TIC Americas 2018. And actually, my question is concerning investors. For example, if I would like to receive funds from investors, so I would like to know how I can value their investment. For example, in this phase that I am, maybe it's not interesting like to get a lot of money, but if I get that money, I don't know how I can like value their money regarding part for my business.
Okay, so if I understood, you want to give the investor you want to give the investor the how much, what are the investors' profits going to be, or how much their money is gonna worth, let's say, in the future if they invest in your company, right?
So,
Okay. So if that's the case, with the two ratios that I was showing before, the two yeah, the internal rate of return, the IRR, and the net present value, those are the things that in general we use for showing investors how their investment is going to do. So in the IRR, for example, that's showing the internal rate of the return of the business, right? So if they invest, I don't know, $100 and the IRR is 15%, they're gonna get two 200 230, right? So we use the IRR. I mean, if you show them the IRR of the project, they're gonna know what their profit is going to be, right? And if you show, and the NPV, what it does is it shows the, you can do, I mean, if you have the NPV, you can do like three rule. You can see, okay, this is an NPV for an investment of $2,000. So if this investor is only investing 500, then what would it be with the $500? So you should divide the amount of the NPV by the amount invested by that specific investor. And a very easy thing to do that it's very used as well is to see, also to do that. For example, so you see the NPV, or you see the future cash flows. Sometimes not even if bring it back to year one. Just see, for example, the company the future cash flows of the company are going to be 100, 100, and 100 in the next 3 years. And then if all the investment you had was 10, then you do this 300. Well, actually, no. Let's say that your old investment you had was 100%, which is more realistic. Then you do 300 over 100, and you're gonna get that ratio of 3 times, right? So you can say to the investor, okay, you invested 100, and we had future cash flows of, like, the future, the worth, what this company is worth is 300, because we obtained 300 in the next years. So this is what your investment is worth. It's worth 3 times the amount you invested. So you're going to get 3 times the amount you actually invested in the first time. So I hope that wasn't too complicated of an explanation. But I would focus on, the internal rate of return that you're getting for your project. They're going to understand that's the internal rate of that's the rate of return they're also getting. And then whatever the NPV is, you can solve. For example, if they're financing 10% of your NPV, and then you can see how much their NPV it's going to be, because it's just the 10% of the NPV you obtain. And then the other thing is so the exit ratio. So, like, how much money you're going to get in the future, you add up and divide by the initial investment, and that's going to give you a 3 times, 2.1 times whatever they invested that they are going to obtain, and you can sell it like that.
Okay, that's great. Thank you.
Thank you.
thank you, Ms. Romina, for sharing your extensive knowledge and for your support. Acknowledgements on behalf of YABT to Ms. Romina Ferreira, as well as to everyone who attended this session. This session was recorded, so we're going to share it on our bootcamp website, www.yabt.net/bootcamp. bootcamp/. Please stay tuned to know more about future sessions because in November we're going to have other sessions about marketing. Besides that, we invite you to follow us on social media. We send you a warm greeting from Washington, D.C., and we look forward to your participation in the next boot camp. Thank you very much and have a great rest of your day.